The US economy's ability to exhibit sustained strength in the face of historic inflation and rapid policy tightening has come into question this month, with a stalled economy or recession becoming the talk of both Wall Street and Main Street. On the data to hand, it could be argued that the US is already in recession. Across the world, a technical recession is defined as 2 quarters of negative GDP growth. In Q1, US GDP contracted by 1.6% annualised, and for Q2, the Atlanta Fed's nowcast is pointing to a decline of 1.2% annualised. Since the US instead uses the NBER dating procedure to define a recession, a marked deterioration in employment is also necessary. So, the first half of 2022 is unlikely to be defined as an official recession. That said, given the starting point and its headwinds continue to build, an NBER-defined recession remains a distinct possibility in coming quarters. Why do we believe headwinds are building for the US? Principally, it is because of the cumulative loss of real household income suffered through the pandemic, with the share of the population employed at June 2022 still 1.3 percentage points below the prior peak, and inflation having printed at a multiple of nominal wage growth for more than a year, materially reducing discretionary spending power. The risks to the income outlook are also skewed. As demand for labour has far exceeded supply over the past 18 months, it seems unlikely that employment growth will abruptly flip from a robust positive to sizable negative. However, the recent tone of activity data and the deterioration in employment partials point to a much reduced pace of job creation and nominal income growth ahead. With the University of Michigan consumer sentiment already at historic lows on concerns over family finances, such a turn of events could see persistent weakness in consumption through 2023. The aggressive tightening of financial conditions over the past 6 months is also proving a substantial negative for the economy. Since December last year, US term interest rates have jolted higher as Fed fund rate expectations exploded. The US 10-year yield, for example, more than doubling from 1.35% in early December 2021 to around 3% currently, having peaked at 3.5% mid-June. With the US dollar DXY index currently at levels last exceeded 20 years ago, global competitiveness is also poised to become a significant concern for business. Combined with the array of global and domestic uncertainties present, these pressures raise concerns over US investment and employment into the medium term, with consequences for household consumption. The chief risk for the US economy is therefore arguably not a shallow technical recession in 2022 or 2023, but rather enduring weak and/or negative outcomes. Saddled with significant federal debt and a tax base dependent on household income, this would be a concern difficult to rectify, particularly if US political debate remains divisive. Now, we are recording this video just after the stronger than expected June CPI report, and so it is not surprising that the market pricing for the FOMC still shows greater concern over inflation than economic activity. But the tide is turning. While inflation dynamics likely prevent the FOMC from easing up in their fight against inflation in July and September, when we expect 75 basis point and 50 basis point hikes respectively, continued weakness in activity through the second half could warrant a new debate over the need for 25 basis point hikes that we're currently forecasting in November and December this year, which, if delivered, will see the Fed funds rate peak at 3.375%. The more material point, however, particularly with respect to term interest rates and the US dollar, is the market's expectation of what comes next. Given our concerns over the threat of enduring weakness in growth and the accumulation of a sizable output gap through 2022 and 2023, we anticipate rate cuts in the order of 125 basis points to a Fed funds rate of 2.125% will prove necessary from late 2023 to bring annual growth back near trend in 2024. If accurate, this forecast will weigh heavily on US term interest rates and the dollar over the next 18 months. We'll see you next time.